Hello and welcome to another video on my YouTube channel. My name is Joris and today I am here with the final video of the series that I'm making about the biggest versus the cheapest ETFs that you can buy on the European market. But as you can see, this video is an exception. I didn't take the biggest ETF compared to the cheapest one, and I will let you know in a minute why. I took the most expensive one versus the cheapest one for looking at the emerging markets ETF that you can buy here on the European markets. If you are interested in other videos like this from other regions that I haven't discussed just yet, so I did the global market, I did the European market, I did the US market, and now the emerging markets, just let me know in the comments down below and I will see what I can do. But maybe you can hear it on my voice. Yesterday I went to a football match and I was shouting quite extensively, so my voice is a bit wrecked from yesterday. But they won, so I'm really happy that our team won. And with that being said, I always went over this slide in the previous videos as well. I'm still going to do it now as well, although it's not the biggest one, but the most expensive one that I'm picking for this video. But I'm always annoyed when I read that an ETF should have at least X million invested into it in order to be, considerable for investing your money towards. Most of the time, experts say that it needs to be at least 100 million, which is already a lot of money when it comes to emerging markets, but that's another thing. I don't believe that that's true. I believe that when you have an ETF that is new and it's cheaper than the previous one and follows more or less the same index, then I believe you should start investing in the new cheaper one, just because the total expense ratio, it matters, and it can be a big part of your return that you lose because you pay a lot to the provider of the ETF and not receive the return yourself. Unfortunately, a lot of people don't even care. They just start investing in one ETF. Probably it was the best one when they started, but 2-3 years later, there came another one along that is way cheaper, and they don't even look at it. And here I underline change because it's really important. I don't say sell all your previous shares of an ETF and buy into the new one. I'm just saying you can also just choose to stop investing towards the old one and start investing into the new one. Because, costs, they damage your return as well. And of course, when an ETF is bigger, it can have scale effects, which can be positive or negative. I already talked about that in the previous videos as well, so I'm not going to go into that any further. So emerging market ETFs, for me, I believe that they can make up a small portion of your ETF portfolio. Around 5 to 20% is ideal. So what you want to pick as a percentage, that's up to you. For me, I think for us it's around 7% that we want EM HD to be in our portfolio, and it can be a really good addition next to your global invested ETF. So that can be also just developed countries. So you can also have a global ETF, so like the All World ETF from Vanguard that invests towards developed and emerging countries. So when you already have that, then you don't need to care about the emerging markets ETF because it's already covered with the All World ETF. But when you look at the numbers in ExtraETF, you have 101 ETFs, of which 34 are providing you with a dividend. So you don't have that many choices, 34, and 30 are physical replicated, and here you immediately have again the same problem with ExtraETF. Probably there is one of the 30 that has two currencies, and then when they have the different currencies, you only see one of them depicted. but it's double counted in the number when you do your selections. So you have 30 physical ones and 3 synthetical ones. So only 30 to pick from. So that's not a lot. And 20 of them are fully replicating and 10 are sampling ETFs. So those are, let's kind of say, sampling ETFs means that the index provider has a bit more flexibility in how they invest new inflows of the fund or even outflows, so that they can look at what they are going to sell, so they don't need to match the index 100% all of the time, while fully replicated types, they do need to match the index 100% all the time. And the total expense ratio goes from 0.15% to 0.74%. So if you go to ExtraETF, you know that I like that site a lot. I use it a lot. And if you take a look at, it should be emerging market dividend ETFs here. So let's take a look. We can go to ETF search. So you have 3,290, but I want the region to be emerging markets. So 101. Then you go to dividend, yes or no. I want dividends, so 34. And then you can go to replication type, and that's the physical ones that I want. And here you can immediately see that you have the iShares MSCI emerging market UCITS ETF US dollar distributing with 4 billion invested into it, so a little bit more than 4 billion. So that's the biggest one. So it's not a lot of money that is going towards the emerging market ETFs, but still it's not that little of money as well. So you have iShares and it's 0.18%. And if you look at the cheapest one, so I have to go to the cheapest one, that's the HSBC MSCI Emerging Markets UCITS ETF. So it's following completely the same index and it's only 0.03% cheaper than the biggest one. It's almost 2 billion invested into this one. So that's why I'm saying that I'm not going to look at the difference between those two, because in fact, when you look at the numbers in just ETF, it's almost 99.9% they are the same. So I'm not going to bother about that. And then you see here the most expensive ones, the iShares MSCI E Emerging Markets Small Cap and the infrastructure one with 0.74%. But they are really specific with small cap and infrastructure, so I'm not going to deal with those. But I'm going to discuss the iShares Emerging Market Dividend UCITS ETF US dollar distributing with a total expensive ratio of 0.65%. So quite expensive ETF, but it's oriented towards dividend. And as my channel also deals a lot with dividend investing, because I like dividend investing, I think it's really nice to talk about those 3 ETFs and in specifically about the HSBC MSCI Emerging Markets UCITS ETF, the HMEF, compared to the IEDY ETF from iShares. So the biggest one, 0.18% of total expense ratio, and the HSBC one with 0.15%. And there is really not much difference between the two. So here you can see the IEEM with a total expense ratio of 0.18%. It's right now 45.66 US dollar for one share. The dividend is distributed in US dollar as well. There are 1,236 companies in this ETF, and it's investing towards the MSCI Emerging Market Index, which tracks the stocks from emerging markets worldwide. And It exists since the 18th of November of 2005, and in the past year it is up 9.65%. The past 3 years it is up almost 26%, and the past 5 years it is up over 46%. So, okay, those numbers are way worse than the performance of the US stock market, that's for sure. But actually, the emerging markets are actually picking up, and especially in the past year, they are really performing okay, I believe. So it's paying out 4 dividends per year, so quarterly payments in the months that you mostly expect for quarterly payments of ETFs. And it has a dividend yield of 2.15%. And here you can see the dividend distributions of the past year. So it pays out on the 13th, around the 13th of the month in which it distributes. And here it has the highest distribution in September with 0.4129 US dollar. Then we can go to HMEF from HSBC. So it invests towards the same market index. So it tracks completely the same stocks as well. It is a little bit cheaper to buy one share. It's 11.694 US dollar for one share. And it has a little less companies in it, but it is increasing. So it was 1,100 and a bit. A little, I think it was about 6 months ago that I mentioned this ETF in on my channel already, and then it was 1,100 and a bit holdings. So it is increasing, and it's nearing the number of the IEEM from iShares. There is almost 2 billion invested into it, and it's been around since the 5th of September of 2011. And in the past year, it performed better than the IEEM from iShares, but in the past 3 years and the past 5 years, it is slightly underperforming the IEEM. It also pays quarterly dividends, and it is changing from January, April, July, and October towards February, May, August, and November for paying out. So you can see here that now it paid out in February and in May, but the years before it was always paying out in the months 7 and 10, but that is going to change to 8 and 11 this year. And here also the same thing. The dividend is higher in July and in October. So you always have an uneven distribution of the dividends, just like for IEEM, but that's just the way it is. With the US stocks, there you almost all the stocks pay out quarterly dividends, and there you have a nice distribution. For emerging markets, it's not the case, just like it's not the case in European countries as well. And then we can go to the dividend-oriented ETF. So that one tracks the Dow Jones Emerging Markets Select Dividend Index, and that tracks the emerging market dividend-paying companies that can sustain an appropriate dividend program over time. So what exactly is an appropriate dividend program over time? Then you need to check the documents of this ETF. So always do your homework if you want to invest in such an ETF. Always go and read the documents of the ETF. You can find them on Just ETF. You can find them on the site of iShares as well. So definitely go and check all those documents out to know what they mean by naming an appropriate dividend program. But the total expense ratio is actually quite expensive with 0.65%. We have the EM HD, that one has also a high total expense ratio with 0.49%, but that's just below my level that I like to see of 0.50%. That's really the highest that I want it to be. And with 0.49, that's way better than 0.65, of course. You can buy one share for 13.306 Swiss francs per share, and the dividend is being paid out in US dollar. It invests in 105 companies, so way less than the previous two ETFs that I mentioned, and there is 646 million Swiss francs invested into this ETF. It's been around almost as long as the previous ETF, so from the 25th of November of 2011. So it's just 1 month younger than my oldest daughter, which is actually quite nice. And in the past year, it is up almost 8%, so underperforming both ETFs that I mentioned before. Over the past 2 years, it is up 27.95%, so there it is overperforming. And then for the past 5 years, it's again underperforming the previous two ETFs. It also pays out quarterly dividends in the same months as the IEEM. iShares loves to pay out in March, June, September, and December, and the dividend yield is really high, 7.70%. And here you can see the the quarterly distributions. So only in March you have a lower dividend payout. Then December is also a little bit lower than the other two, but still quite nice with 0.28 US dollar being paid out in December. So only in March it's actually quite lower than the other payments. And if you look at the top 10 holdings of the dividend-oriented ETF, there you can see completely different stocks than from the HMEF from HSBC. So it's incredible how much difference there is, in fact. So you don't see, I don't believe you see one company that is the same in the top 10. So in fact, when you want to invest towards both and invest, for example, 10% in HMEF and 5% in IEDY, I can completely understand that. It's completely correct to do that if you want to do that. But once again, not financial advice, just an observation from my part. And also the distribution in countries, that's more or less the same, but here Brazil is way higher than in the HMEF, where it's only making up 2% compared to 18.19%. So if you like Brazil, then the IEDY is of course a better choice than HMEF. But here you can see, yeah, it are two completely different ETFs, so that's quite nice to see for once as well. In the sectors, once again, for HMEF, you see technology appear, which is way down here for the dividend-oriented ETF with 5.59% compared to 23.71%. Financials, it's more or less the same, 5% less for HMEF, but not yeah, actually it's a nice representation of how you expect dividend-oriented companies to be. So in financial, basic materials, energy, utilities, and industrials, compared to where you see the return being higher, and that is technology, telecommunications, basic materials as well. So especially technology, that's the growing sector. So and the performance since its inception for the dividend ETF. So that one is up 39.10% since its inception. You of course have here the dip of 2014 and a half, halfway 2014 it started dipping until the beginning of 2016. And then you had COVID as well. So this dip is something that you don't see in other ETFs because there the markets are just steadily going up and up and up. But for emerging markets, this period was a really tough period. You have the COVID problems, and then here, of course, yeah, it's The same period that you see for the S&P 500 as well, but there the drop was way less. But when you invest into the emerging markets, you know that the volatility is going to be bigger. For the HMEF one, you see the same thing. So from 2014, 2015 on to the beginning of 2016, you see a significant decline. And then you have also the COVID pandemic, and then once again until October of 2022, again a huge drop of the market. But this one is up since its inception with 57.22%. And if you compare both from the moment that the youngest one started, you see that the iShares Emerging Market Dividend UCITS ETF is up almost, or I will say it's up a little bit over 39%, and the HSBC MSCI Emerging Markets UCITS ETF is actually up 75%, 0.50. So almost double of what the iShares Emerging Market Dividend UCITS ETF is doing. So if you look at that, you see that there is a huge difference between those two. Between the biggest one and the cheapest one, it's really small because they invest towards the same index. And so I would go for HMEF because that one only costs 0.15% in total expense ratio compared to the YEEM, the IEEM one from iShares, where it is 0.18%. But the dividend oriented and the cheapest ETF is not that straightforward. Okay, the cheapest ETF wins for sure, so the HMEF one, because it's almost double of the performance of the dividend oriented one. But over the past year and the past 5 years, it's also worse. But over the past 3 years, it is actually better. And that's because you had a very bad period in those 3 years. And when you have a bad period, the dividend oriented ETF always gives less volatility. And yeah, that is why I say, are dividends bad? Yes or no? Most of the time they underperform, but in moments that the market is really going down, they overperform the other markets, and it's what you prefer. So if you don't like to see your portfolio going down by a lot, then I would say dividend ETFs are way better because they are less volatile. They are still going to drop, that's for sure. And you can do a lot of great things in the period that they are going down. If you buy extra shares, you are going to increase your dividend yield. So that's again gains for in the future. And it's all up to you what you decide and what is it worth to you to see that your ETF portfolio is less volatile than the portfolio of somebody that only invests towards growth-oriented ETFs. So for my wife and I, we went for the less volatile option and are more towards dividend-oriented ETFs. But Europe, well, what's the best for you? I can't say that, of course. So we went for EMHD. It's also a dividend-oriented ETF, and it has a total expense ratio of 0.49%, so which is way better than the IEDY ETF with the expense ratio of 0.65%, but it's still quite high. And we like EMHD. We are still a little bit in the red for EMHD, but we are definitely going to buy more at the end of the year when we accumulated again around 500 US dollar from our dividends from our different ETFs in our portfolio. And as always, I advise you do your own due diligence and decide wisely. And with that being said, I'm glad that I can start resting my voice, because you can hear it, my voice isn't that great anymore. But please consider subscribing to my YouTube channel. That would mean a lot to me. And hit that like button as well. That helps out the channel enormously as well, because then this video is distributed to other people that like this kind of content as well. And with that being said, thank you for watching to this one, and see you on the next one on my YouTube channel. Bye.